Welcome to the DIY Wealth Canada podcast, a show by independent investors for independent investors. Join hosts Bob and Nelson as they discuss investing, personal finance, and much more, all from a fiercely self-reliant Canadian perspective. As a reminder, nothing you're about to hear is investment advice. Thanks for listening and enjoy the show.
Hey, everybody. Welcome back to the DIY Wealth Canada podcast. I'm Nelson. I'm here alongside Bob. And today we are going to talk long-term investing. This episode is going to be 10 stocks to buy and hold forever. They might be Canadian stocks. They might not be Canadian stocks. Who knows? We might throw a little bit of a curveball into this. Bob, are you excited about this one? Ready to go?
Yeah, I'm very excited. It will be interesting to see you and my list and compare because I think there will be a lot of overlaps, but it will be interesting when we get down to like number 7, number 8 or so.
Exactly. And let's maybe start off with what are the characteristics that you are looking for in a buy and hold forever stock? Like, is there one or two things that you can really point out that it's like, hey, I want this and I want this? Or is it more of kind of like the whole package kind of thing?
I think a bit of both. I think having a company with very strong moat, that's number one. Number two would be kind of what we talked about when we mentioned about hedge your consumption, like a company that's hard for people to switch, and a company that could be strong regardless what the economy might be. What about you, Nelson? Do you have any thoughts on that?
I've got a few things that I have looked for in this past. So one, I think that it has to have a growing dividend. Now, give a little peek inside my thought process. Not always do I insist on a company having a growing dividend. Usually I do. It's probably like 80 to 90% of the time now that it's like, hey, if I buy something, the dividend is growing. Sometimes it's like the value is really compelling or, like the growth or whatever. Like there's other reasons there. But for this exercise, it's like, hey, like I want that growing dividend because if I never plan to sell, then how am I supposed to get income from the investment? Of course, so it has to pay me a dividend, and I want that dividend growth. I also want, you talked about the moat, Bob. I agree 100%. I want an excellent business. That's what I'm thinking about when I'm looking at long term. And I think that I mostly limited myself to Canada. This is the Canadian DIY podcast, so I'm going to limit myself to Canada here a little bit, just because it's my investing universe. But saying that, like, Bob, I think that, you might have a name or two, maybe outside of Canada. Here's hoping to kind of spice things up a little bit. But just for me, it's like, hey, I just focus on the Canadian market. I still have some stuff outside of Canada, but that's kind of my focus. So why don't you start, Bob? What would you put as the number one? And I don't think this is in any particular order. So what do you want to start with for your list?
Yeah, I think let's stick to Canadian side first. I think I could just imagine the top 5 would be all Canadian banks. So I'll just name off right off the bat Royal Bank. Royal Bank is one of the biggest banks in Canada, has a very strong dividend history. I think the company's paying dividends since the late 1800s uninterrupted. Sure, they didn't raise dividends during the financial crisis, but since they have raised every single year. So yeah, it's pretty strong. And like I mentioned, pretty wide moat, service of many Canadians. They are also outside of Canada. So that's good in terms of geographic diversification. And they've been raising dividends, like I mentioned. And I think just earlier past week, they raised, I forgot, like 4% or something. Maybe a little
No,
more.
it's like 7%.
7%. Yeah, you're right. They're one of the biggest payout raisers. So that's music to my ears.
That's exactly it. And Royal Bank for me too was number one. What an excellent bank and an excellent company just in general. Bob, you talked about the moat, you talked about the international exposure. What I like about Royal Bank is when you look at them domestically in Canada, in terms of every major banking category, whether it's mortgages, whether it's credit cards, whether it's wealth management, they are either number one or number two market share in the country. And you don't get that kind of dominance by accident. by far the best Canadian bank out there. I cannot say enough good things about Royal Bank. And when we had our episode about our largest portfolio holdings, Royal Bank is my largest holding. I put my money where my mouth is on this one. I have one more Canadian bank on my list. So what do you think is the second best Canadian bank, or like kind of that second choice in terms of banks you would have on your list?
Let me guess, drum roll, TD, maybe?
That is not mine, but
Oh, interesting. That would be my second choice.
not a bad choice by any means. Why don't you tell us why you like it?
TD is very similar to Royal Bank. Again, one of the biggest Canadian banks, and then TD is very invested in the U.S. market as well. Again, good dividend grower. Again, very similar to Royal Bank. Nothing wrong with TD. No, Royal Bank is one of our top 5 holdings, and so is TD. So no problem holding in TD. Just buy and hold, nibble on it every so often when the price is kind of at 52-week low. And TD has done really, really well for us. Same as Royal Bank over the years.
What I like about TD, or what I've liked about them lately, is of course they had this giant money laundering scandal in the US, got fined something like $3 billion or something, was blocked, and they tried to acquire another bank in the US, and they were blocked because they were in this trouble with the regulators. And I remember, Bob, you probably remember too, when the share price, collapsed. I think it was in like kind of that, 70 to 75, maybe 75 to $80 range. And everybody was writing off TD. It was, these guys are going to be terrible. They're not going to be able to do anything. They're so limited by the regulators. They have to get out of the US. Like just all this doom and gloom. And what did they do? They just roared back. I think the stock's at about 150 now as we record this. Like it's been a double in, call it, 2 years. Just a fantastic performance. And like Canadian banks are not the kind of stocks that double in 2 years. Like they've done incredibly well lately, but just that kind of performance from such a stodgy old Canadian bank, it has just been like fantastic. They've done such a good job turning the company around from this, it's going to zero and it's doomed, to what it is today of just resuming that growth in Canada and taking that excess money from the US that they're not allowed to reinvest back in the US and moving that into Canada. Just a masterclass in how to deal with this crisis, and the market responded. But my choice for the number 2 spot is National Bank of Canada. It does not get the attention as the other banks do. Like I always talk about the big 6 banks, but a lot of other people talk about the big 5. It's like because National just does not have that coast to coast exposure. They're getting there with the acquisition of Canadian Western Bank. But what I like about National Bank is kind of this twofold thing. One is they're almost entirely in Canada. They don't have these foreign operations. They do a little bit. They own a bank in Cambodia, but for the most part, this is a Canadian bank. And Canadian banking, I think, is a better business than US banking and maybe banking in other parts around the world. Return on equity is higher. You've got this better like efficiency ratios. And it's just Canadian banking is just this comfortable oligarchy. And so everybody is doing well in Canada. So basically, National, most of their business comes from Canada. Therefore, their financial results are maybe a little bit better because they're not weighed down by these US operations, these other foreign operations. And the other thing is that they're small enough that the growth is generally a little higher than the rest of the banks. Royal Bank, excellent growth. TD has been a good grower as well. And then kind of the other banks, have been a little bit, not quite as good. National is right up there with Royal Bank and TD Bank in terms of growth. Like they've just done a really nice job doing both of those things. And it has translated into the highest return. So if you look at the past 20 years, dividends reinvested, National Bank is the best performing Canadian bank. It's returned about 13 to 14% per year. So anyway, that's why I like that one. Bob, what do you got next?
That's funny because when you say no to TD, right away, I figure you would say National Bank. That's something I really like as well. I think their acquisition of Canadian Western Bank it's a great strategy to expand them to the Western Canada, right? Get more clients on Western Canada. So that's a good acquisition. Yeah, they've done really well over the years compared to the other five Canadian banks. So yeah, National Bank it's another one I would have picked. But since we're already talking a lot about banks, let's move on a little bit. One on my list would be Brookfield Asset Management, BAM. I picked BAM over Brookfield Corporation, although I would have picked Brookfield Corporation as well as another buy and hold forever. The reason I like BAM a little bit better is the dividends is a little bit higher than Brookfield Corporation, and it's done fantastically over the years. Just from a dividend side of things, BAM pays a little bit higher dividends. It's been growing dividends, and their asset under management has been growing quite significantly. So I think that will be growing. It's not going to slow down in the near future.
I 100% agree. And that one was actually on my list too. So it's a great time for me to talk about it. What I like about BAM and this, like the asset management part of Brookfield rather than the parent Brookfield, Brookfield Corporation, there's two things. And one is I want to talk a little bit about the fundraising process. I saw Bruce Flatt, the CEO, talk about this one time. And he says, he's like, look, we can predict our growth fairly accurately over this kind of like 3 to 5 year time period. Because what happens is their big customers are the largest pension funds and insurance companies and all these big institutional investors. And these institutional investors have money pouring in constantly, whether it's, insurance premiums to an insurance company or pension contributions for a pension manager. This money is it's flowing in constantly. And what happens there is like they have to make plans for it. You can't just react when you have that money. You have to say, okay, like we know there's this much money coming in and we have to invest it over time. And this is how we're going to invest it. So they make these kind of long-term commitments to BAM, and BAM is the beneficiary of that. And so they're projected to grow kind of revenue and earnings by about 15% a year for the next 3 to 5 years. And I think that's a very achievable target. So you have a stock that's yielding 3.5 to 4% right now, and you're kind of got the ability to grow the dividend by 12 to 15%. Like that is a very impressive combination. And I look at, pension plans and just all this institutional money in general, and I just see more and more money pouring into that and pouring into these, kind of alternative assets that BAM can give these guys exposure to. The other thing is I like BAM in terms of it's an asset light business. Brookfield Corporation owns real estate and they own chunks of, Brookfield Energy Partners, renewable energy, and then Brookfield Infrastructure. So Brookfield, the corporation, is very much a business that holds hard assets, and that's fine. Like there's nothing wrong with that. But I prefer the capital light part of the asset manager. The asset manager just manages the assets, and all of the cash flow, coming from that, the excess profits can just get all channeled back to dividends. It's a fantastic kind of model, and that's why I like it so much. Okay, what do you got next, Bob?
Sorry, just go back to the asset lie because I think listeners will probably wonder about that. Do you BAM and Brookfield Corporation are obviously very similar. Like the structure of the company is very complicated. But given a choice, you said asset light. Is that always something you prefer, or just depends on the company?
Yeah, it definitely depends on the company. My view of Brookfield itself is that there's this collection of stuff on that balance sheet, and it's good stuff. I don't want to, like try to disparage it or anything, but I think that in general, the market always assigns a discount to collections of stuff. It's like the conglomerate discount. You just about always, with the exception maybe like a Berkshire Hathaway or something, a collection of these kind of unrelated assets are always worth less than the assets themselves because, why buy Brookfield if you can just buy Brookfield Infrastructure if you want exposure to infrastructure? So the reason to buy Brookfield, in my view, is that there's this discount to the sum of the parts. And I just don't see how that ever corrects itself. Now, that doesn't mean that like the value of these assets won't go up. but I just don't think that the market ever values these assets in terms of what they're actually worth. And the big thing with Brookfield is the commercial real estate part of it. They had Brookfield Property Partners. They took that private because they didn't think the market was assigning it a proper valuation. They're probably right there, but it's sort of this kind of thing on the balance sheet that, I don't think that investors will ever give Brookfield credit for, like they'll value it at like say 60 cents on the dollar rather than $1. And with Brookfield Asset Management, you just don't have to worry about that. Like it's just, hey, they get the assets, they get the management fee, and everyone's happy. It's valued on the cash flow rather than the kind of this discount to book value.
Yeah. So my next pick would let's go. I'm going to go outside of Canada, so I would go with Visa. Visa is a very well recognized name. Almost everybody has a credit card in their wallet, and I could guess the credit card typically would be either a Visa, a Mastercard, or in some cases American Express. So I would say Visa and Mastercard are probably the top the top percentage in terms of people have in their wallet. Yeah, like Visa makes money from the merchant when you make a payment, and they also get money if you don't pay your balance full, and so on and so on. So it's just a money making machine, and their dividends been growing over the years. It's a great business to have. It's not going away anytime soon, right? Sure, there's electronic payment coming up, but Visa is innovating in such a way that they're definitely defending their business. So I think that's a great business to own forever.
It's a toll road on the economy, basically. Like it's just, if you want to pay for something, chances are you're going to do it with either a Visa or a MasterCard. Obviously, there's exceptions, but I find like, Bob, when was the last time you paid cash for anything? Like I have this old crumpled up 20 in my wallet that's been there for, the last 8 months because, hey, you never know, you might need cash one day. I would much rather just pay for things with plastic, get my reward points, use those towards travel, like we talked about in a previous episode, and just kind of, like it's fantastic.
Yeah, I can't remember last time I paid cash. Well, actually, when we were in Japan a few months ago, but that's a different scenario. In fact, I was crossing the border for work the other week, and the border guy asked me how much cash I have. And I was like, I have no idea what's in my wallet in terms of cash. I actually had to pull it out and check. And I sure enough, I had like a $10 bill. That's just like you said, it's all crumble. I haven't used it. So yeah, don't usually use cash. So again, I think Visa is great when it comes to that aspect, right? People are using credit cards more and more, and you almost can't make transactions without a credit card, like all the online payments. You cannot buy anything online without a credit card or some sort of, I suppose you could do PayPal and stuff, but why wouldn't you just use your credit card? Just so much easier.
Yeah, that's it. It's like, why? And that's always been my, people every now and again, they pitch PayPal to me as a stock. And it's like, that just sounds like crappy Visa. Speaking of toll roads on the economy, I'm going to use that as my theme for my next pick, which is Canadian National Railway. When I look at the railroads in Canada, you have these assets that, first of all, they're very tangible. The moat is very tangible here. You have the ability to walk to the train tracks and actually touch and feel the moat. I'm a student of history. I've read books on the history of Canada. And one of the things they talk about in these history books is how when the railroads moved across Canada, the big motivation for the railroads is that they owned this land that the railroad was on, and then kind of a lot of this like kind of land alongside of it, which they were able to sell to help pay for it and et cetera. But the point is that there's special laws in place that says that these rail tracks going across the country, the railroads own them, and the government cannot, for whatever reason, say, hey, like this is our land now. It's just that's theirs forever. And this network that connects the cities, connects cargo, doesn't really connect people anymore. That's just an irreplaceable network that I think gets more and more valuable over time as cities get bigger, as the country gets bigger, the country has more people. It's the lifeblood of the Canadian economy, and I want to own a piece of that over the long term.
Yeah, that's CNR is actually my number 5 pick. So you beat me to it, Nelson. Again, totally agree with you. It's the backbone of Canada and North America in general. Most of the goods are transported throughout North America via rail. It's probably the most efficient, cost-effective transportation method. I mean, air, it's faster, but it's expensive, right? So rail is a lot cheaper in that sense. And you could travel long distance pretty easily via rail.
Mhm.
The conditions that build a railway connecting the rest of Canada to BC, that was one condition. And, the last spike, that was pretty famous. So, yeah, totally agree with you. CNR is a great company now. It has faced some pressure in the last year or so, mostly because the geopolitical pressure, terrors, and so on. But I think this is going to go away eventually. They'll continue to raise dividends. People are going to continue to rely on railways to transport goods. And Nelson, you're right. It's mostly goods, not people. But you still need to transport things from point A to point B, and you need to rely on rails. So, yeah, that would be my number 5 CNR.
All right. Let me pivot a little bit, and I'm going to go to my number 3 choice. We kind of got a little bit because our lists aren't exactly the same here, but I'm going to go with Fortis. Bob, I would maybe, I'll guess here that might be on your list, but let me talk about Fortis here for a minute. It's just Canada's largest utility. They've got regulated electric assets. They've got the natural gas assets. And then they've spread into the United States and into the Caribbean as well. Part of the reason for me, we talked about a little bit about hedging our consumption, and that's a big reason for me why Fortis is on this list. My view is that if I can get enough Fortis shares, my power bill essentially pays for itself, and I'm protected against any increases over time because anything that's going to get passed on to me, the consumer, is going to be good for Fortis. It's Canada's second most consistent dividend grower. It's increased dividends every year for more than 50 years now, just 1 year behind Canadian Utilities, which is the longest grower. These guys are just solid in every aspect of that word. They grow kind of, 4 to 6% a year. The dividend grows by the same amount. It's a really, really good company. And I'm happy to tuck it away and forget about it until we talk about, we do lists like these and it comes back up again. Bob, is it on your list or have I jumped the gun a little bit and,
Oh,
maybe?
absolutely. I think Fortis is definitely on the list. We're kind of talking about the same ones, it feels like. But yeah, you mentioned you checked off every reason why I would hold Fortis. It's kind of one of those boring stocks where you don't really think about it and just kind of chuck along in the background. That's exactly what you want, right? Like, I kind of think building a dividend portfolio or investment portfolio, like building a professional hockey team, like you need your star players that's like, could skate really fast, could score really good, but you also need these like steady Eddie players, and Fortis would fall under those steady Eddie players category where you're kind of like you could just rely on them and they'll do what they're expected to do. You don't really need to worry too much about it, and that's exactly what Fortis does, right? It's been raising dividends like clockwork. It's a stable business. Everybody needs services that they provide, and yeah, it's a wonderful business. Sure, it's boring. It's not as exciting as any of these AI stocks, but you're going to be fine over the long term. The swing in terms of price isn't as high as these AI stocks, so it just you can just buy it and buy every so often and then just leave it in the background. It'll just continue to make you rich. So definitely on my list. I'm gonna go again outside of Canada. I think we're on to number 6. My next pick would be Alphabet or Google. Alphabet has 2 voting classes. So one is GOGL, which is the voting class A, and then class B doesn't have voting rights, so that'll be GOG. I would tend to pick the voting right share, but whichever you feel like. Why do I like Google? It's just a giant in the tech industry. They make billions of dollars every quarter. People were doubting them in terms of search engine because this whole AI stuff, but they show they could adopt and build AI into their search algorithm. Gemini has been pretty powerful. In fact, Apple is now going to use Gemini to power their Siri, right? So it's demonstrating that Google is definitely it's a company that you don't want to forget about or snooze on. Yeah, and they just do so much stuff in the background, right? They're also in healthcare. They have a lot of different startups under different names. And they kind of do this model of try everything, fail fast. I mean, if you look at Google's discontinued product, you'll see there are lots and lots of different products. They tend to like to try many different things and see which ones stick. But one of the key reasons I like Google is, I think most people I know have and use Gmail. Gmail is free right now, but imagine Google just said all of a sudden, hey, it's no longer free. It's $1 per month or $1 per year. I would imagine 99% of people, or maybe not as high, 90% of the user would pay that money, no problem, myself included, because it's just such a service. It's just pain in the butt to have to switch your email address, right? And then when Google came out with their phone, they came out with this Google Drive, it's unlimited photo storage, and then they now limited the storage size, and lots of people are paying their Google Cloud services, right? So it's just a very easy way for them to make money. And yeah, they don't pay a lot of dividends, but their return has been phenomenal over the years. So Google would be my I guess number 6 pick.
I wanted to ask you, Bob, one of the things, I mean, first of all, Google's a fantastic company. I don't own any, but that was a mistake on my part. I definitely should have done that. But saying that, the one thing that kind of makes me pause a little bit with Google is you mentioned the dividend is very small and there's really not a lot of dividend growth there. Like I think the last increase was something like 4 or 5%. And Google's, bottom line is increasing much faster than that. Are you concerned as a buy and hold forever shareholder of this company that you think, like the dividend growth isn't really keeping up to the growth of the company? Or do you think that that'll happen at some point in the future? Maybe they don't have quite as many things to invest in.
I think that's going to happen sometime in the future. And really, when you invest in Google, you're not really in it for the dividend portion. Sure, it's nice to get a dividend payment, but you're more investing for the total return aspect. And I mean, they could just all of a sudden pay quite a bit of dividend, right? You look at NVIDIA, recently they jumped their dividend payout ratio quite a bit. All of a sudden they're paying a lot more. So Google could definitely do the same thing. They have the money sitting in their pockets. So yeah, I'm not too concerned on Google in terms of dividends. And that, again, like I mentioned, that's not really a dividend play. That's more of a total return play there.
Yeah, exactly. Okay, I'm going to talk about another Canadian company here. This is one that isn't really a big dividend payer, but the growth is fantastic. And we talked about this one before, Bob. My favorite retailer, Dollarama. And I did a YouTube video on Dollarama a few weeks ago now. And I just like these guys, they've done so many really smart things in terms of their ability to compete in the Canadian market. But I'll highlight just a couple of them here. And one is that, I don't know, Bob, have you ever been to a dollar store in the US versus in Canada? Like, can you maybe talk a little bit about that experience? Have you noticed that? Like, it's maybe not quite as good down there?
I can't remember the last time went to a dollar store in the US. So yeah, I would have to defer to you, Nelson. I from what you said, I was imagining it's just not a very good experience in general.
Dollarama has successfully figured out how to market themselves to the middle class, upper middle class in Canada. And in the US, dollar stores just don't do that. They're used by people who have to use dollar stores. And it's unfortunate, but what that does is it really doesn't create a very good shopping experience. But Dollarama has figured that out where it's like everybody in Canada goes to Dollarama. It doesn't matter what your income is. The stores are clean, they're nice, they're well put together. And that's just this really underrated advantage that they have, that they can go into, wherever, and they can say, "Hey, we're here." And everybody wants to go. Dollarama, we're coming up to like 2,000 stores in Canada, and people say, well, the growth is tapped out. I disagree. I think Dollarama is going to, their next step is going to be rural Canada. And there's like kind of these cities of between 1,500 and 3,000 people that have like one grocery store, and that's it. And so I think that Dollarama really, really does well in those markets. Okay, Bob, what's next?
Okay, I'm going to stick with another US company. I talk about Apple a lot, but I'm going to take Apple as one of the buy and hold forever stock. We got into Apple many, many years ago. That stock has done really, really well for us. And in our top holding, that was one of our top holdings as well. Again, Apple, yeah, it's been 50 years of company history. It's been transformed by Jobs and then Cook, and now there's a new CEO coming. I think what Tim Cook did really well was he's an operational guy, so he basically built up the operational side of things, being able to manufacture different devices and so on and so on. He's definitely not a hardware guy or a product guy, but he knows this operational side of things, right? You could see how well Apple has been able to run so efficiently. And the reason I like Apple a lot is just the ecosystem, right? The Mac, the iPhone, the watch, and so on. There are lots of rumors about they're coming out with glasses. I'm pretty sure that that's going to be one of the new products they'll launch eventually. Apple historically hasn't been the innovator is not the right word, but like they're not the technology leader. They don't come out with the first product. But what they've done really well is almost perfecting the product in that category, right? So you look at iPhone, they were definitely not the first one coming out with iPhone, but they made it really, really well, and everybody liked it. Same with, MP3 player, right? iPod, right? Before iPod came out, MP3 players were everywhere, but Apple really, in my opinion, perfected it. Right now with the ecosystem, everything is tied together. It's really hard once you get into the Apple ecosystem. It's really hard to exit. Yeah, the company is doing great. And then with the new CEO, he's a hardware guy. So I think he will be spending a lot of time with his team to focus on the hardware aspect, the product aspect. But I think they'll pick up. And with Apple, what I really, really like in the recent releases is the Mac Neo, right? If you look at university education, Apple basically owns that segment. Right, lots of people like you can look at students, university students, college students. They all typically have a MacBook or MacBook Pro, MacBook Air, so on. The thing with Apple Neo is it taps into the even younger generation. Right, you tap into the high school kids, even the elementary school kids. They're cheap, they're easy to use. Like right now, Chromebook owns that segment, but I think Apple is really attacking that younger generation segment. And what happens when kids are hooked up on Apple? Guess what? They'll use Apple for the rest of their life. Right? So it's just like automatically turning people like kids into their customer in the future. So Apple is, I guess, this is number 7 on my buy and hold list.
What I like about Apple is the iMessage moat. And what I mean by that is when you get into a group chat and there's an Android user in there, the Android user gets ridiculed because the group chat gets all like messed up, and they get pressured into getting Apple products just so they can join the group. But anyway, I'm going to pivot to a REIT. I think that it's important to, I don't know if it's important, but I just like the idea of owning real estate. I thought that's how I got my start, as you guys know. So when I look at a REIT that I want to own forever, what I want is I want a kind of like a long-term thought process with management. And for me, there's really one REIT that really does that in Canada. That is Choice Properties REIT. Choice Properties, of course, was the spinoff of Loblaws. They own a bunch of Loblaws, real estate, retail, and industrial. They just acquired First Capital, a bunch of their Loblaw and kind of grocery anchored property. But what I really like about Choice is the Weston family owns a gigantic chunk of it. The family, this is a long-term family that plays long-term games. They're in this for generations and generations. I think it's about like the fourth or fifth generation of Westons that are running the company today. And that's what I want from a REIT. I want a company that just thinks long term and wants that tie-in with Loblaws, which is probably Canada's best retailer. So, it doesn't pay the highest dividend. It might not even have the highest growth. It's just solid in so many ways, and that's why I like it so much.
Nice. I like that pick as well, although it's not on my list. My next pick would be Manulife. This was one of our first stocks to hold. The reason I like Manulife, it's a dividend growth machine. I think the dividend has been growing on an average about 10% or so in the past 10 years. No reduction. They reduced their dividends in during the financial crisis, I think in 2008 or 2009, but that was kind of a global event that forced Manulife to reduce their dividend. And Manulife has been expanding in Asia for many years, and that expansion has starting to pay off. Life has a very significant presence in Hong Kong and Singapore, so that's been helping them in recent years. The dividends have been growing, I mentioned, and I think the payout ratio is relatively safe. It's, I think, around 50% earning to pay out. So, that's pretty safe. So I think Manulife will continue to grow dividends. And generally speaking, very strong balance sheet and credit quality. Manulife is an insurance company. I mean, most people either use Manulife or Sun Life, so it's very big in Canada. So that would be one of my picks.
One thing that I like about Manulife is you talked about they cut the dividend during the financial crisis, and there were a bunch of people that just Manulife was dead to them. As soon as those dividends got cut, it's like, I'm never buying Manulife shares again. And to the company's credit, they took that and they said, hey, when we emerge from this, we are going to make sure that we're in solid shape and we don't have to worry about a dividend cut ever again. And Bob, you talked about the strong balance sheet. You talked about the growth in Asia. It's just like they really just kind of hunkered down, got to the point where it was solid again, and then just really started hammering the dividend increase. It's a little bit like Brookfield Asset Management, where it's like the yield is pretty close to 4%, and you're getting these kind of 8 to 10% dividend raises every year. Like, there are not a lot of companies in Canada that offer both the yield and the growth. So, it's not on my list, but I think it's a fantastic pick. I own it. It's just not on my list. But I will talk about another insurer that is on my list, which is Intact Financial. And what I like about these guys, they're a little different business than Manulife. It's a property and casualty insurance. So that's insuring your house, car, boat, etc. These guys are fantastic underwriters. That means in insurance, they make money on the underwriting process itself. Of course, remember, an insurance company makes money two ways. One is they take in more in premiums than what they pay out. And then two is they invest those premiums and they get earnings, dividends, interest, etc. from that. So Intact has made money on the underwriting side consistently over time. And then what they've done is they'll go to the United States, or they'll go into Europe, or they'll go into the UK, and they'll acquire something. They'll take their underwriting expertise and they will improve the underwriting of these companies that they have acquired, making them more profitable, and then passing on these excess profits to investors in terms of these increased dividends and so on. It's about time for them to buy something else again. It's been a few years now. They're kind of building up cash in order to do that, but there's maybe not a lot available. But what it combines to is you've got, right now it's about a 2.5% dividend, but your dividend growth is outstanding. Like, it's been 10% per year for most of the 20 some consecutive years that they've increased dividends. So I think it's just I think it's a fantastic insurance stock, a little different than Manulife, but they're both good in their own ways.
Yeah, that's definitely something we hold as well. Moving on, I mean, my next pick would be Enbridge. I don't think we mentioned any companies in the energy sector, so this is my first pick in the energy sector. Enbridge, also you talked about the tolling aspect, right? Enbridge is almost like an infrastructure toll roll. It's not an oil company, basically charges money to transport and natural gas via their pipelines, right? So that's definitely very enticing. And with the way it's getting harder and harder to build pipeline, it seems to be getting a little bit easier compared to say 5, 10 years ago. But it's still, it's cost a lot of money. You know, you have to go through all these studies and so on. So their existing network, pipeline networks, are more valuable than ever. And what I like about Enbridge is it's been growing dividend quite consistently. The yield is relatively high, so the dividend growth rate isn't as high. But if you start off at 4%, 5%, even growing at 3, 4, 5% is still pretty decent, right? It's definitely keeping up with the inflation. And Enbridge is now making some transformative moves by getting into more almost like utility-like, right? So they purchased 3 natural gas utilities in the US, right? Trying to get into more utility companies, structures, so not completely just relying on transporting crude oil and natural gas, right? I think they have mentioned the board or the management has mentioned they would love to grow, continue to grow about 5% for EBITDA. And, that seems pretty decent for a company that's already, yielding quite high. So that's one of my picks.
I really like the move into utilities for these guys. I think that over time, our exposure to oil, especially, is going to go down. Not anytime soon by any means, but it will go down. And I think that we will get to a point where we have enough pipelines. And then at that point, what are you supposed to do if you're Enbridge and you grow? Would you either increase the prices, which they can do that, they have the ability to do that, or you expand into other things. And utilities is, there's a bunch of kind of fragmented utilities across the United States that Enbridge can acquire. I'm a fan of that strategy. But this will be my last one, and then Bob, I'll give you a last one. My last choice is TMX Group, Toronto Stock Exchange. We talked a lot about kind of toll roads to this and toll roads to that. If you want to list in Canada, you have to list on the Toronto Stock Exchange. And what happens in periods of high commodity prices, oil is doing well, gold is doing well, a lot of rare earth minerals are doing well, and so on and so on. That directly benefits the Toronto Stock Exchange. These guys get more revenue, and the whole thing just sort of grows and grows over time. The other thing that these guys are doing, which is very smart, I think, is they're diversifying into kind of investor information services. They have the data, so package up the data and sell it back to investors and let the investors make their decisions based on that. You're working with institutional investors, they have the ability to pay. There's a lot of growth there, I think, that TMX Group can do, in that field. I'll also add that they own the Montreal Exchange, which is derivatives options. In today's world, there's a lot of risky investing going on. We've done episodes on bubbles. We talk a lot about how much risk it seems like people are taking. I like the fact that as a TMX shareholder, I get paid a little bit every time that somebody makes a stupid options play. It's almost like a tax on stupidity, and I'm happy to get a small portion of it.
I like it. So my last pick, I'll go a little bit outside the norm here. I'm not going to pick a company. I'm going to pick an ETF because we're hybrid investors. So my pick would be the iShare X Canada ETF XAW. Now Vanguard also has a similar one called VXC. We pick XAW just because it has a little bit higher exposure in the US than VXC. The reason I like this one is it's very simple. It invests everything else outside of Canada, right? So basically you own everything outside Canada. So it gives you that geographical exposure. It's quite heavy in the US. I think it's about between 68 to 70% invested in the US. But, you look at the US, there are so many different big multi-billion-dollar companies. So that's a good way to tap into markets outside of Canada and gives you exposure outside Canada. So XW would be something I would continue to hold, just kind of buy regularly and just wait for it to grow over time.
Yeah, we've talked in a previous episode about how there are 11 billion ETFs out there. In fact, I just read something recently that on the TSX, there's something like 2,100 listings on the TSX, and like 1,200 of them are ETFs. ETFs are outnumbering individual stocks these days, or if they're not, it's very close. Like there are so many ETFs. And the nice thing about that one, and like a few other ones, like honestly, there's about 10 ETFs on the TSX. Maybe there's a few more, but not many more that you should pay attention to as a DIY investor who wants to keep things simple. There's so much complicated stuff out there that there's a lot of value in just having that ability to say, hey, one company or one ETF exposure to however many thousands of companies outside of Canada. And all you have to do is just buy some when you have some spare cash. That's the ticket. If I wasn't a hardcore whore for dividends, I would take some sort of like really simple approach like that and just, Bob Schrunkle. So I agree 100%.
All right, Nelson, that was fun. I think we're up against time here. So with that, I think we'll end the episode here and let us know what you think about our picks and if there are any company that we may have overlooked or missed. We'd love to hear from you. Let us know. Nelson, any last words to add?
No, I'll just stick with that. We do YouTube, Spotify, leave comments. I do actually respond to them. So yeah, let us know what we missed. I would love to hear everyone's thoughts on something that we may have overlooked. I'll just know what you think should be on your list, maybe not necessarily our list. All right. Thanks, everyone. We will see you next time.
If you enjoyed the show, make sure you subscribe to never miss another episode. For more from Bob, visit his site at tawcan.com. That's TAWCAN, all one word. Nelson can be found at CanadianDividendInvesting.com. They're both on Twitter as well. Just search for Tawcan or CDI Newsletter. Thanks. See you next time.